So the yield is still looking very solid, and our view for some time has been that the main reason to be in the banks is the yield, and it is quite attractive, and our view has been that it will remain attractive. Now, a lot of that capital uncertainty, as you all know, is out of the way. So with APRA clarifying capital rules, that's providing more support to those dividend yields. So our base case at this stage is that there won't be any cuts to nominal dividends for any of the banks. The capital positions are looking quite comfortable. Loan growth has also been quite low, and the banks have been looking to optimise their capital positions by shedding low-returning risk-weighted assets. And these factors have also been bolstering the capital positions and providing support to dividends. Now, like I said, the main reason to be in the banks right now is those div yields, which are fully franked and very attractive. There isn't too much by the way of EPS growth, so we think the outlook for income growth is improving, but it's still subdued. So we are expecting net interest margins to expand going into the next half, largely as a result of repricing of interest-only home loans and term deposit competition reducing. So our views there remain unchanged. And with system loan growth, we think that would be around 6% per annum. Now, with our view on system loan growth, that was looking quite optimistic in kind of around April or May, once the sequel to the macroprudential rules were announced with the limit on the interest-only loans. But it's turned out, our view so far has turned out to be fairly correct in the sense that credit growth is holding up. What we're seeing is a change in the composition of housing lending growth. So we're seeing lower investor home loan growth, but we're seeing owner-occupier home loan growth pick up because of increased competition in that space. And what that has meant is that overall system home loan growth has held up. In fact, since March, it's actually ticked up a bit. So the 12-month ended growth in March was about 6.5%. It's now running at 6.6% for the last 12 months. So I think the consensus forecasts for credit growth are now looking quite they'll need to be revised up. So income growth will still be subdued, but we think that it's an upward kind of trend. It will improve from what we're seeing in FY17. So generally in FY17 across the banks, we've been expecting 3% income growth. Over the next couple of years, we're expecting it to be closer to 5%. In terms of asset quality, very quickly, Ben, in terms of asset quality, look, it continues to remain benign, and what we've seen in the last round of reporting it by way of full-year results in quarterly trading updates, we've seen no overall deterioration in credit quality. So that remains okay for the moment as well. And with that, Ben, I'll pass it over to you.